So at this presentation, we're going to learn about new banking systems. The title is Beyond Underpants, Finance of Space Entrepreneurship. Please help me welcome Brian Hanley.
So, is there anybody here who's not a sci-fi buff? Okay, you wouldn't raise your hand anyway. There's something missing from sci-fi stories. They're heavy on technology, all that, but money is just magic. It just happens. Technology just has the resources and it works. Well, that's not how it is in the real world. And what I'm going to present to you is a new method in banking. Banking is the most disruptive innovation in human history. Everything that you're looking at, except for the humans, but perhaps arguably them as well, was made possible by banking. This blue line here, that's not a rocket trajectory. That is a graph of the classical banking multiplier. And it has an asymptote at 1 over r, r being the reserve ratio, which is how much money does your bank need to keep on hand out of all the money that it's got outstanding. If that amount is 5%, then you can create 20 times that much money. So I think it's important, given the topic that I'm going to discuss, to make clear that this is peer-reviewed material. I started 8 years ago on this path, kind of by accident, blundering along. I was lecturing at the Levy School of Business under Kevin Walsh. I brought something to him. He says, you should develop that. So I did. 3 years later, I ended up publishing this novel multiplier equation in the Economics Journal out of the University of Kiel. And for that to happen, John Quiggin and Steve Keen both endorsed the publication, which is really rare in economics. And I've also had the pleasure and the privilege of having Jeffrey Gardner as a critic and sounding board for what I'm going to present. So let's start at the beginning, which is, where does money come from? In the modern world, money comes from debt. This book is a really good one, Debt, the First 5,000 Years by David Graeber. I recommend it. He's an anthropologist, he's an economic anthropologist, and in this book he puts to bed the fairy tale that economics made up out of, just because they thought this made sense, about how money originated and how banking and credit originated. Anyway, in the modern world, for every dollar that you have in a bank account, you've got a dollar of debt somewhere else that created that money. Now, this isn't quite exactly true. There are exceptions, and I will hit one of those later. So what did I do? I identified an emergent phenomenon in banking that happened in the run-up to the 2008 banking crisis. This was not something anybody planned. It was not designed. It just occurred by accident because of the interaction between these entities. And what happened was banks made loans, we know about that, on real estate, and then they bought insurance policies, credit default swaps on those loans from American International Group, and then that allowed them to take that insured asset, because to a bank, a loan that is outstanding is an asset, but it's an asset that's in the suspense account. When they insure it, they can move it back into the capital account, and then they can handle it as if it was a deposit and then loan it out again. So you created this circle, which is a very powerful money creation mechanism that is a new multiplier. So great, we need money creation. For every person that's born that has a job, you have to have money created for them. for all the technologies we create. You have to have money created for that. But there were obviously problems. We had a breakdown in the banking system. And the first problem is a theoretical one that is well recognized, which is that the underlying asset, which was real estate, does not change in utility value typically when it changes hands. The change in utility value occurs when you construct something for the first time, or if you make a major renovation that improves the property for real in terms of its usability and what it can do for people. And so that set up a scenario for a bubble. The second problem was a technical one, a little bit of a complex technical one. AIG was in the insurance business. They didn't really understand credit default swaps. They didn't understand derivatives. They'd never been in that before. Derivatives are unique. Derivatives come from the commodities industry and stock futures. And in the futures markets, think about it this way. If a farmer sells a pork belly future, because he's a hog farmer, and time comes to collect on that future, and he realizes that the price of pork bellies has gone way up, and he could make tons more money, well, what if he could, say, file a motion in court or get an injunction from a sympathetic judge to stay this as a negotiating tactic so he can get more money? Well, that would totally destroy the futures markets. So you can have them run that way. That means that derivatives have to be exercisable instantly, and they are. Nothing can stop it. Bankruptcy won't stop it. Nothing stops it. That's why MF Global crashed. You can look them up. And it was literally overnight. Everything, they reached in their bank accounts and they just took everything.
You haven't said what a derivative is.
Well, that would be too long of a conversation. A derivative is, well, these are classed as derivatives. So what that meant was AIG was an insurance company without a claims process. And they weren't really expecting to pay very many. And so, but when the banks were insuring these loans, they were making more loans, and then they were selling off these loans in packages, and then keeping the insurance. And they noticed that, hey, when one of these loans goes bad, we get paid. And so we double our money. This is really easy money. So then, hey, we had them targeting people, liar's loans, no credit check loans, targeting people who probably would fail, and that's what broke the system. So, after publishing this, I thought about it, and not yet. That we can talk about at the end. Okay, I have some comments in the paper that I wrote on it. The question I started asking was, can venture capital work this way? Because it seemed to tick off all the boxes. Because venture capital is where new utility value is created. Well, venture capital, but entrepreneurship is. Since Schumpeter, this has been really clear. And venture capital allows entrepreneurs to do what they want to do. JP Morgan at the turn of the century, before we had our current system, the revised system of banking and the current venture capital system, they were venture capital. He was a venture capitalist, and he was backing Edison and Tesla and making lots of money that way. Also, we price utility value in stocks, utility value of companies in stocks. And the stock market is, when a company goes IPO, that is the creation of money on a large scale. Also, and that is one of the rare exceptions to the rule that there's $1 of debt for every $1 of credit balance. Banking has a general problem that has been known for a long time, since the beginning of banking, and it hits banks periodically, in that deposits tend to be short-term and volatile, and people want to be able to get their money out quickly. when they want it. But investment needs are long-term and need to be stable. And periodically, banks get caught in a credit crunch where they have too much money taken out. They have to reassess everything, so they have to call in loans or call in lines of credit. Sometimes corporations crash. This happened last year in England. So with this new mechanism that I identified with, the circle of insurance, that would create deposits that were on the same term as the investments. This would be good. So, okay. Can I design a system that cures these problems? And then, after I started thinking about it, well, how am I going to test it? Because I don't have real world data. But I found some from Kaufman Fund. And this data is from 99 of Kaufman Fund's. Over 20 years, they had invested in 99 different venture capital funds. Now, each one of these funds represents multiple investments. So this is a really broad portfolio, and when what we're talking about here applies to broad portfolio. And from that, well, let's see. We then go to, let's say we create this bank. The multiple of original capital. The original capital is the money that you put in to start the bank. Okay? And the Basel Accords, which are the overall overarching regulations for banking around the world now, they define Tier 1 and Tier 2 capital as that is your reserves. And it's defined the way it is to try to make sure that the investors in banks hopefully who are operating the people who are operating the banks have enough skin in the game that they're not going to drive the bank over a cliff. So you can have 15% of the Tier 1 capital, which is the last thing to get paid off in a liquidation, as this type of asset, an insured asset. And 100% of Tier 2, so you do the math on this and you end up with, you can create up to 47 times your original capital. So let's take a, oh, Christ, this is, can't see that. This is, not sure why this is. Okay. So the top is the underwriter, the bottom is the venture bank. We're going to talk about the underwriters first, because the underwriters are actually the keystone to this. If you can't get underwriters to sign on and provide your insurance, it's not going to work. So the instrument that I created has both, the DIN stands for Default Insurance Note, and it has a payment, a yearly payment, like a regular insurance policy, and in this modeling run, it's 5% of the value of the investment loan that's made is paid every year. And on the far right, you see the equity fraction. And what this is, in order to make this work, I backloaded it, which means that at the exit, when the venture capitalists exit and make their money, they do their IPO, they do their M&A, whatever it is, they 50% of the equity that's produced off of that investment that was insured is paid to the underwriter. It's given to the underwriter. And this makes it work. So using the Kaufman Fund's classical total portfolio return, which is 31% over 10 years, the then underwriter would pay $8.43. They would receive $50.14 at the end of that time period. They would have $41.71 profit. They'd get around a 6 multiplier, which is somewhere around 20%. This is good business. The venture bank has, what you see here is, now this is using a simplifying assumption, which is that on average, you're going to have the same return over the whole large portfolio system. So what you see here is that the amount of money that the venture banks make depends on how many times they can turn their original capital. How many times can they reloan it? And I have limits at, I have 30x as being a probably conservative limit where most venture capitalists would be able to do 30 times to get enough deals that were of good quality to do that. And at the top end, 43 times is the limit that I set, because if you're in finance, you do not want to put yourself up against the wall. You want to have some headroom. You want to have some money in your back pocket in case there's an emergency and you really, really, really have to say, rescue one of your investments for some reason, something like that. These are really good numbers. The best venture capital fund that Kaufman invested in had a return of 8x. And this means fairly pedestrian, you can get to 13 to almost 20. So now let's look at returns for underwriters over different conventional net portfolio returns. And what you see is that even if it's a totally pedestrian fund, this shaded region, by the way, is the region where most large portfolios wind up. They wind up somewhere between 0.9, losing about 10%, to top end about gaining about 50% over 10 years. And what we see is that a pedestrian fund is going to pay off it's going to be almost 3 times for the insurer, which is pretty good for them. I'm not really going to dive into this deeply because this is just an alternate way that underwriters look at how their business is working, and it's how much you've insured, how much money do you get on per dollar that you're insuring. And this dark region here I have marked because in that area, the underwriter pays nothing, so they have 0 invested, and so and no net carrying costs. So there is no such thing as an ROI. Essentially, everything they make is gravy. So I started after the 2. I've done this a bunch of times, and I'm not doing that. So this is the model. This is the returns for the venture bankers. Now the clawback lien is a feature of the default insurance note where, yes, the insurer pays it off, but then they also get a lien on the bank so that they can do a back-end claims process. So you deal with that problem there. So then we ask ourselves, how much Tier 1 capital is required? So actually, not Tier 1. How much initial capital is required to create $1 trillion in investment funds? And the answer is 21.25 billion when you do the math. But practically, because you've got 30 to 43 as your real world range, you're looking at 23 to 33 billion dollars. And the point here is that there are people in the world today who have this kind of money, who could do something like that. Is $1 trillion enough to build a colony?
Yeah. Yes.
Maybe. So recap, by harnessing the discovery of this accidental innovation in banking, we can create up to 47 times the base capital. Both the venture bank, the investors, and the underwriters can make higher returns than they can today. And even dead average venture funds become great performers. To do this, I'm proposing a venture banking system where, if you think of this venture bank utility as sort of like Google Web Services, it's the cloud, a banking cloud. And each one of these bank 1, 2, 3, 4, 5, N banks, each one of those would slot in as a venture capital fund. And that way you should get a wide portfolio, and the venture bank utility can manage the kind of of venture capital funds that they take on so that you can get that coverage. So these are my references. I'm happy to share these slides with anybody who wants them. And are there any questions?
Anybody but Bill? Anybody but Bill?
Yeah, we got this lady over here. Yeah, go ahead.
Yesterday in my talk, I observed that in Star Trek, nobody has pockets, nobody has wallets.
Or wallets.
How do you think banks will have to adopt to an environment?
On Mars.
Yeah, on Mars.
Okay, yeah, I've done work on that, and that's a different talk. And I actually have that, but it would take too long to go through. And then her first.
Okay, so you're talking about insuring the venture capital.
Insuring loans, processing venture capital. See, currently venture capital is essentially money lending. So they don't get leverage on the loan leverage. And one of the reasons it's such a powerful mechanism is that when you write you're essentially, there would be essentially writing a loan to themselves and creating new money, and that becomes the money that they invest. And then once they write a loan, then they insure that loan. That allows them to handle that as if it was a new deposit.
But you are talking about banks, venture capital process.
You would have to have a bank.
Not the entrepreneur,
Well,
investor, single venture capital.
the venture capitalists currently would, the venture capitalists would operate just the way they do today. It's just that their investments would be handled as loans rather than just here's money and this money is out of this account and it's over there. They would create the money for it. Yes?
So I'm concerned about how the venture capitalists handle uninsurable externalities.
That is a matter of looking at the broad portfolios, again, and historical records. And there's some pretty interesting stuff from Mulcahy in that paper, where one of the things that they found in analyzing their results was that unlike stock, any other form of stock investing, there actually was a pretty strong correlation between past performance and future results for venture capital firms, which means that some of those firms are learning how to do things right or something. We're not exactly sure yet, but something like that. Yeah.
I guess my question is about a time horizon. I mean, what we've often talked about in the new space community is this sort of fundamental mismatch between venture investments that need a payback time in sort of 3 to 5 years versus the
3 to 5 years for venture capital is it's a total fiction, and that's one of the other things that this Calvin Fund paper said. Those venture capital investments virtually don't exist. 10-year hold times are real. Some of them are longer, but average 10-year hold times are real. But I've had this conversation with a few venture capitalists, and they're still wedded to this BS. But this is just how that's just one of the other obstructions.
Can I ask a follow-up?
Let me get Mr. Melton.
Have you proposed a pragmatic plan for the Mars Society by which they could generate incrementally funds to build for the future?
I have not worked on that today, no.
It might be a good idea.
It's possible. I've been focusing in this area on making sure the model works, making sure there's no errors, having people who know what they're, who really know what they're doing, looking at it, trying to find things wrong, et cetera. So, yeah, your follow-up question? This guy.
Yeah, so the follow-up question. So you're saying VCs by and large think that they want a 3 or 5 year payback, but in reality they tend to hold things for a decade or so.
Yeah.
Is there any way to push that longer? I'm not saying all investments need to be so long-term, but it seems some
to push them to get real?
Yeah, maybe have a rate for some of our.
I welcome your help in this matter. Yes, back in the corner.
So what is the term of the insurance?
The insurance terms, it's renewed on a yearly basis, and the idea is that the contract would be, the contracts would have to be made upfront for up to 10 years, cancelable by the venture bank, as they needed to. Actually, I have a paper that has a lot of details. There's a lot of details to consider in this, to make sure that this kind of adversarial relationship will work. There's a handshake there. Yes.
What level of implementation is this at, and what would be the next step?
The next step really is finding a venture capitalist who wants to try this. And I talked to, what's her name, the CFO at Heidi Roizen. I talked to her, well, I emailed her back and forth. We ended up not actually following through because she didn't want to create a liability for her company, and she's the CFO, that's her job. I have a friend who has worked with with Jurvetson in the past and is trying to get his attention, but billionaire bubbles are really thick, and it's so that's one of the reasons I'm giving this. This is, by the way, the first public presentation of this that's happened. I've given talks to a number of space CEOs. I've given this to securities attorney. I've given it to economists, et cetera. And nobody prior to you has had this in less than 3 hours. This is really quick.
Just to interrupt for 1 second. Is Einar Fulstein here? You're here. Okay. So this is the last question then.
Okay.
Yeah.
Sir, the money that Elon Musk has for SpaceX, is that venture capital that you got, or is that?
It's venture capital. It was started by him, and then he's gotten venture capital investment. He's also got bonds that funds that he's raised. I think he's got about $8 billion of that, or he did, and he's also running a very tight ship in terms of his cash flow. He's making it's a business, and it's a solid business.
Is that a good model for what we're talking about?
Well, I mean, that could be part of it, I was kind of hoping there might be some people from SpaceX here who might hear this and go, hey, well, that sounds interesting. Maybe we could have this guy come and talk, but, we'll see.
All right, let's thank Brian for